Hello everyone, welcome to another platform tutorial focusing on order entry. So in this particular video, I want to use HPQ, it's HP Corp, for our example, where we have a little bit of an uptrend going on here, and we want to try to rejoin that uptrend on a pullback to 1871. I always like to put protective stops in on my option positions. I know the risk is limited to the premium that we pay when we get into an option, but if I can limit that risk even further, then I want to do that the moment I'm proven wrong in a bullish trade. So if prices go below 1771, I want out. And then of course, we've got a couple of price targets up here around 21 and 23, a little over 23 and a quarter. So we're going to use this trade as our example. And I wanted to show you this just so you had context of kind of what was going on and why I was setting this trade up. Now, this is going to be for a bull call spread. So we're going to buy a call and sell a call on the same stock at the same time with a bullish overall outlook. Now, I've gone ahead in the to respect the time here, I've gone ahead and typed in using this Thinkorswim price slices, all of our entry prices, our stop loss, our target prices. I've already established our risk reward based upon the position that we're looking to enter, which is the 18 by 21 bull call spread. Estimated to cost us around $1.10, maybe $1.15, $1.20, somewhere around there. So we don't have to worry about what we're anticipating paying for this. Right now it's quoting $1.42. We're still waiting for the price to drop a little bit further, and I'm going to show you a neat little trick here. If you've been following Traders Army, if you've been following us, and you know that we have some really neat tips and tricks and tools that we use to really get specific and negotiate our way into and out of our option trades. And so I just anticipated that it would cost us about $1.10, $1.20 to get in, but we don't have to worry about that in the order entry. I just use that when it comes to risk reward, and I'll show you why we don't have to worry about that when it comes to order entry. So I've been starting out inside the Analyze tab to build and analyze all my trades. Once we are done analyzing the trade, what I do from here is I right click and I create a duplicate order. That brings up the order bar from the very bottom. You can see if you've watched other order entry videos of mine, then what you'll see is you can actually expand and contract this order entry bar down here, this little menu down here, which gives us access to kind of hide it and bounce around the platform and look at other stuff, and then we can come back and bring it up and we have our order entry down here. So it doesn't disappear, it just hides itself for a moment. So the first thing we want to do is we want to consider, I want to enter this position. And when I say I want to build an all-inclusive order, I want to include our exit orders as well. So I want to include the entry, I want to include the stop, I want to include the targets, or at least one target for this example. This way we can just kind of set and forget and walk away and not hover over the computer. So first things first, let's talk about the entry order. Thinkorswim by default creates these advanced orders, but just keeps them single orders. So the one thing you're going to want to do is you're going to want to drop this menu down here, and I'll kind of make this a little smaller so you can see. We're going to be choosing what's called first triggers sequence. And so first trigger sequence is what I use for the bull call spread. One target, one stop loss, keep it simple. And now that we have this advanced order first trigger sequence, what I can do is right click anywhere on the entry order, and I can create an opposite order. And the reason I do this now is I haven't modified any of the conditions yet in which we want to get in or out, but I've gone ahead and established how many orders, exactly how many orders we're going to need to set up our entries, our stops, our targets. And the sell order, or the closing order for this vertical spread, is actually only going to get sent to the marketplace, A, once our conditions are met, but B, once the first order actually fills. So we're going to get into the trade first. If we never get into the trade because our entry criteria is not met, then the sell order to get out never gets sent. That's what this first trigger sequence means. So first things first, let's go ahead and set up our entry conditions. So if we keep the chart up top here, 1871 is the condition under which we want to get in. So on Thinkorswim, you can go all the way to the right-hand side of either one of these orders, and you can see that there are some cogs that pop up when I hold my cursor over. So we want to click on the cog for the entry order, and that's going to bring up the order rules box. Now the order rules box which is broken up into 3 different sections: the order itself, the conditions under which we want to send the above order, and then a plain English description on exactly what you're trying to set up. So first things first, I want to go ahead and set up the condition under which we're going to actually get into this trade. So if I just go down to the order conditions panel and I just start clicking underneath symbol, method, trigger, and threshold, there's already some default information that populates. So we're waiting for the price to be south of or less than or equal to 1871, which is going to be our entry price. Okay. And we're going to go ahead and save that. Actually, I want to go back in and show you one more thing. Check this out. I was a little quick there. So 1871 is our threshold in which we're going to send the above order. Now, the above order is a limit order, which is currently priced at $1.41, but we don't know exactly what the price is going to be when HPQ hits 1871. So what this platform lets you do is one of 2 things. Number one, you could not fuss with anything fancy and just go for a market order, which is basically this: if HPQ is ever at or below 1871, buy this bull call spread at the market price. Now, a lot of times I don't like to use market orders, especially on the way in, because you're going to ultimately get the worst possible fill. It's a blank check, right? So what I do in Thinkorswim, they actually allow you to go back to a limit order and actually link the limit to the mark price of the spread. Many of you have seen me do this on other order entry videos, and if you haven't, head to tradersarmy.com, unless you're on tradersarmy.com right now, and check out some of these other advanced order entry tools, because what this allows you to do is when HPQ meets conditions and the stock is below 1871, this platform will actually look at the bull call spread that we're looking at buying, and it'll grab the mid price at that moment. So we don't have to try to guess what the mid price is going to be. It'll actually grab the mid price, and if we don't offset this in either direction, if we don't offset it, it's just going to submit the buy order to buy the bull call spread at the mid price, which is negotiating between the bid and the ask. And so what you'll find is a lot of times you'll get filled if you put it in right at the mid price, but not always. And if you really want to get into this trade, but not you have to use a market order to do so, but you want to improve the probability of getting your order filled, what I want you to do is I want you to look at this little section down here that says mid and natural. Well, this is the bull call spread, mid price, and the natural ask. And so the ask is always going to be a bit more expensive, and we would like to pay a little bit closer to the mid price, but notice it's about a 10-cent difference between the mid and the ask. What I'm going to do here is I'm going to negotiate. I'm going to say, okay, don't send it right at the mid price. I'd be willing to pay you 50%, which is the difference, so 5 cents above the mid price, which will get you a little bit closer to the natural ask. It won't take you all the way to the market natural ask, but it'll get you above the mid price. And so you're basically saying, I'm willing to pay 5 cents above the mid price to own this bull call spread. And the odds of you getting filled there are extremely high. Still not guaranteed, but extremely high. I, knock wood, have never had an issue getting filled when I offset 50% between the mid and the natural ask. So if we save that, that sets up our buy order. Now, essentially, we're going to do the same thing. I want to keep these good till canceled this way. Now, the entry order, you might not want to keep good till canceled. You might want to kind of evaluate this every day. But if you did want to leave it good till canceled, you can leave it there. But the exit order, I definitely want to leave good till canceled. And so we're going to go over here to the cogs on the exit order. And I'm going to click on that cog, and it's going to give me my order rules. I'm just going to move it over to the main screen here. And here we have the same type of order rules box. And so we're going to enter the conditions under which we want to now get out of this bull call spread. So we know that we're going to have a stop loss on HPQ if the price continues to drop below 1771. Then if HPQ is also ever greater than or equal to, this is going to be our target, 2099, that's actually going to also be a condition under which we would want to go ahead and sell this position. Now, again, if you're newer to options or you don't want to fiddle around with anything fancy or advanced, then just make the price rules a market order. Again, a market order is the worst possible fill, but it will guarantee that you get out of your position if one of these conditions is met. And so it's acting kind of as an order cancels order, but it's one order to sell the the whole option spread with two different conditions under it. Now, there's another way if you want to set up, for instance, multiple targets. There are similar ways that you can do that. I'll make another video on that, or I have made another video on that by the time you're watching this. And so go check out multiple targets when dealing with debit positions. So debit spreads, buying calls, buying puts, etc. So if you want to get fancy, right, and kind of negotiate your way out, then we'll make this market order a limit. Okay, and we're going to do the same thing. We're not going to try to guess what the limit price is going to be when these conditions are met. We're going to change the limit linked to mark price, which is the mid price of the spread. So right now it would just submit it at the mid price. But again, you're not guaranteed to fill at the mid price. And because this is our protective stop, we want a little bit more, a higher probability that we're going to get our order filled and get out of this doggone position. So again, a market order is not wrong. You could use a market order. But if you want to try to negotiate your way out, set it up, link the limit to mark, and then subtract 5 cents or 50% of whatever the natural, bid price to the mid price is. Now this is only about, let's see, well, the market just closed, so this just got, atrociously wide. It's 12 cents wide just on the bid to the mid. So it's not atrocious, I guess. But we can go ahead and assume, let's just go ahead and split that 50%. So it's a 12-cent spread here. We'll offset by 6 cents. Now notice I subtracted, whereas before on the entry, I added 5 to 6 cents. So why am I adding to the other one and subtracting from this one? Well, you have to consider this order is to sell. And anytime we want to sell something, we have to, if we want to improve the probability of getting filled, we have to sell for a little bit less than the mid price. And that's why we subtracted 6 cents. Where we want to buy, if we really want to get our order filled, we have to be willing to pay, in this case, a nickel above the mid price in order to buy. So anytime you're buying, you offset upward, you add pennies. Anytime you're selling, you decrease or remove pennies, and you say, I'm willing to go 6 cents below the mid price to sell this position and get the heck out. And so what this now allows us to do is go ahead and confirm and send. And you'll see here, if I go down to buy one vertical, okay, buy one vertical, it's the 18 by 21 call, bull call spread, because there's two options there. We're willing to pay 5 cents above the mark price or mid price, but only if HPQ is ever at or below 1871. So if the price never drops to 1871, we don't have to worry about getting into this trade. If we do get into this trade, it'll immediately send the next order in the sequence, which is to sell that same spread for 6 cents less than the mid price, but only if HPQ is at or below 1771 or north of 2099, which is our stop loss. And so once this is all set up, we go ahead and send this position. And if I come over here to the monitor tab, you'll see we have been doing a lot of order entry exercises here. We have our order waiting. The market's closed, so it's not going to fill just yet, but it's there waiting for us. Anytime you want to cancel it, you could or modify it in any way. You can right click on your entry or your exit order, whichever one you want to edit or modify. Right click, cancel, replace, and you can go ahead and replace any portion of your working orders up until the point that they are filled. So with the market closed right now, this isn't going to fill until some other day, possibly tomorrow or another day into the future. But nonetheless, we have to wait for price to hit our entry zone anyway. So hopefully you guys got a lot out of this. Hopefully you enjoyed this. If you have any questions or want to dive deeper into other different orders for other different types of trades, credit spreads, debit spreads, iron condors, you name it, head to tradersarmy.com. If you're already there, you can find those under our platform tutorials. They are free trading videos for you to watch at any time. If you have any questions, email us support@tradersarmy.com or text us. The phone number's on the website in the top left-hand corner. We're happy to help in every way that we can. Until next time, take care. Thanks for watching. Bye-bye.